Hey everyone, nice to be here at Token 2049. Gonna be talking about the multi-chain future. Maybe just a brief introduction. I'm doing research at the block, and I focus on layer twos, cross-chain stuff. Really excited to meet you guys. And maybe you can introduce yourself, Ryan.
Ryan, I'll jump over for a second. You good?
Yeah.
Okay. Oh, there you go. Backup mic.
All right. Hello. All right. I'm Ryan Zarick, co-founder and CTO of Layer Zero Labs. Layer Zero is an omni-chain interoperability protocol that lets applications on disparate blockchains communicate with each other. Things that can be built on top of Layer Zero are like bridges, omni-chain NFTs, cross-chain governance, things like that. We also built the first bridge on top of Layer Zero, Stargate, which is a native asset bridge currently on 7 EVMs.
Hey guys, my name is Hart Lambert. I'm the founder of a project called UMA, Universal Market Access. We are an optimistic oracle. What that means is we're an oracle that can trustlessly and permissionlessly get any verifiable data on chain. And one use case, the reason why I'm on this panel, one use case for UMA is that we can talk between chains, and we can verify data on other blockchains trustlessly and permissionlessly. And because of that, we, like Ryan at Layer Zero, we actually built a cross-chain bridge called Across. And we can talk about that too, but Across is a cross-chain bridge. It's a native asset bridge like Stargate that focuses on capital efficiency and trying to be the most capital efficient bridge, which we think will ultimately lead to the lowest fees and best usage.
My name is Richard Muirhead. Hi, yeah, everybody can hear me, great. They're killing it on the intros here. It's a lot of fantastic energy in the room. I'm managing partner of Fabric Ventures, so been focused on Web3 150% since 2017. Kicked off investing back in 2013, actually. But you know, I feel extremely privileged to be sitting up here with these guys who are very, very deep in the details of what's going on in this particular space. My history dates back to wrestling with the configuration of Cisco's routers, or routers, as some people like to say, which of course made their name by being multi-protocol. And so what's interesting to me as an investor is a couple of things. One is trying to look at this whole evolution from Bitcoin is the only blockchain to Ethereum's kind of got it right. It's nicely kind of programmable and Turing complete, and we can do great things on it. Through actually there's a bunch of drawbacks. Could anyone ever compete? That's happening. To oh my gosh, we've got layer bridges and and baskets of bridges and all sorts of things on top of that, and trying to navigate. Well, what is this? Is there an analogy with the development of programming language or of infrastructure as a service as we know it today, or routing and communications that helps us work out where great startups are going to arise? And I do think that we're at a really exciting inflection point in this particular space where there's super talented people in the space. There's a big market, but yet it's still uncertain. And I'm hoping to learn a bit more in this chat exactly where the use case is going to emerge.
Yeah. So I guess like to find out what are your guys vision about how the multi-chain future will look like? We've seen so many layer ones and layer twos emerge just over the last year alone. So in future, towards the future, what do you guys think the blockchain space will look like? Will we have a lot of layer ones still, or will we all converge on a few settlement layers? What are your thoughts?
Yeah, I mean, I think it's clear it's going to be a multi-chain future. There's just tons of different trade-offs that you have to make between each chain, and depending on your application, there's different use cases, right? Some gaming applications need speed, like Solana or the future Aptos and Sui. Some need high level of security, like Ethereum. likely layer 2s where you get that security and have rollups or potential ZK in the future. And they all offer different benefits. And so building applications in the future will be multi-chain likely, where people will build an application that exists on multiple chains and takes advantage of the speed of, say, Solana, and then the security of Ethereum, where you keep your assets, and say the storage of an Arweave or IPFS.
I think it's still so early. What's becoming clear to me is that there are like zones of sovereignty, to steal Vitalik's phrase, where there's kind of like this EVM ecosystems around Ethereum, and there's a Solana ecosystem, and then there's this kind of Cosmos ecosystem. But what this multi-chain future looks like, I think so depends on the usage patterns that we just don't know about. People talk about like the app chain thesis right now. All these different applications are going to run on their own chain. Maybe it's a layer 2 that rolls up to Ethereum. Maybe it's a Cosmos app chain. But like if that happens, we're going to have a very specific multi-chain future where I think people are bridging between these app chains frequently. I think it's just so early, and we don't have the data to understand all the plays here yet. But very clearly, we are going to have different systems that people bridge between. It's just, for me, is it going to be a super high frequency thing, or is it going to be like, hey, I move to this chain and I stay there a while? Yeah.
Yeah, so the perspective maybe I'd like to bring on it is that we still see a lot of, so you've got the beginning of applications, particularly in the DeFi space, that have managed to span across multiple chains. And like Aave would be an example. It's on a few different ones. But generally speaking, if you're thinking about the next hot area that's really taking off, it's in gaming. And if you're a kind of a sort of AAA kind of studio who's trying to work out, who's trying to sort of got trade-offs in terms of time to market and how beautiful they make the game and so forth. In general, they're sort of saying, well, I want to keep it as simple as possible and then let me just stick to one chain. I guess what that leads me to believe is that you're going to have to get to the point when there's enough games that are out there that are competing in terms of the user experience, and therefore going to need to kind of fine-tune, like, whatever exactly, that you're selling some transactions over here, you're onboarding some players over here, you're maybe even running your physics engine on a blockchain over here. If we've heard of some people doing that. I'm trying to work out how that would work. And because that end result is a better game for the users, and it doesn't feel like we're quite at that point yet. I think there's some fundamental challenges. We were talking backstage about the atomicity that you can achieve in one blockchain that is pretty hard to achieve when you're spanning multiple blockchains.
Yeah, I mean, so just to riff on that too, the other thing that's interesting in this bear market, gas fees are down. And I think, I'm curious if Ryan agrees on this too, but I think high gas fees is like a forcing function for the multi-chain future. The higher gas fees go, the more it's going to be like, we got to find ways to scale. It's just going to be like pushing really hard to have people expand horizontally onto the chains. So I think that's like an interesting point.
I mean, gas fees are down now, and so if you're building there thinking, oh, this is how it's always going to be, the next bull market, you're in for a surprise. And so then you're put in a spot, where am I going to build that? So you're going to pick another layer 1 or a layer 2, and will that be here in the next couple of years? And then are you going to put yourself in a spot where you pick one and that chain dies, and what happens to your users? How are you migrating over? Thinking omni-chain first, and thinking, even having it built in where you have messaging and you're able to say use like layer 0 for messaging, and you don't actually deploy in other chains, but you leave that out and that optionality, so that as these layer 1s and layer 2s mature, you can decide if you're going to stay where you are or if you're going to expand and use the benefits of some of those other chains. Yeah.
I can buy that. Back in Web 1, I can remember the phrase they used to use was actually the meta, the better. Of course, in this case, it's now the meta, the better, as long as you're not actually meta.
Meta.
But so so exactly, for developers, if you can have that convenience of not having to, make those trade-offs earlier, make those choices, makes a lot of sense. But there is another, if we're trying to work out how we get to that point, there's a sort of school of thought that say, look, at the moment, and this is evidenced by what you've both sort of built, is that it's sort of value bridges that it's all about, and that at the end of the day, that liquidity, will trump everything. Forget messaging and kind of like, composing apps on a sort of cross-chain basis. It's just liquidity, and therefore the kind of, the deepest liquidity, that's wormhole or whatever it is gonna win out, and that's gonna also happen in the short term. Do you agree with that?
I mean, that's assuming that like all of crypto is just about, DeFi and assets, right? And it's not about also building other applications on top, like, social media applications or gaming applications that are actually fun to play and to game. And like secondary part of that is, oh, cool, I own my actual assets and I could sell them later if I want to, but the fact that I have control over them and not the game that is issuing them to me means that they're mine and mine forever. Is like, that's that's how you're onboarding the next, 100,000, 100 million users, right? Is making it usable and not just making it about, degen crypto.
So there is like, and Arnold, you can interrupt us with questions here too. But,
No, because I think one of the things that I was thinking about when you guys are talking about all this design and the trade-offs, one question that comes to my mind is that you guys at Layer 0 have like Stargate, whereas Uma has built like a cross, right? So what's like the difference between the two, and like, what are your design philosophies and the trade-offs that you're going to make,
Yeah, I'll let him speak to across. So Stargate is a native asset bridge that is actually, its intended use, even though consumers use it, is actually to be infrastructure. We built Layer 0's messaging protocol, and the first thought we had when we built Layer 0 is, we need the ability to move assets, right? And we don't believe wrapped assets are dangerous, right? As essentially, it's not really wrapped. We call it an IOU. Someone owes you money on the other side. If that contract's gets hacked, which happens every month nowadays, that IOU is worthless. And so we wanted to have native asset pools on each chain. And when you were crossing the bridge, or any like when you cross any other bridge, or you were basically, that's the only time you're at risk. And when you get off the bridge, you own the asset, right? There's no, no IOU, no potential case where you could get hacked. And so we built that, and the concept with it is that you could send and call. And so SushiSwap did this recently. They launched SushiX Swap, where you can go any asset to any asset on any chain. And this is a perfect use case of what Stargate was built for, in that what they're really doing is swapping on a SushiSwap, so to USDC or USDT, bridging that USDT to the other side, and then swapping on SushiSwap on the other chain to get whatever asset they want. And from the user's perspective, it's one click, one transaction, and they get that asset on the other side, whatever they want, which is the best user experience you could provide.
So there's a lot here that Ryan and I really agree on, and I'll go back to just one way I explain it, is I look at there as being two types of bridges in this world. One I call the lock and mint bridge, where I take an asset, I lock it on its native chain, and I mint an IOU, like a representation of that asset on the other chain. Sorry. Yeah. All right, sorry. I mint a representation of it on the other chain, and that model, I think, is also dangerous. We're in agreement there. There's some use cases where you need to do it. There is no such thing as Solana on Ethereum. If you want to do that, you need some sort of representation of it. But I think I prefer, like Ryan, our design philosophy is we prefer this native asset concept, where instead the bridge is actually a convenience method to make it easy to move between canonical versions of the asset on different chains. So I think that's an important thing for the audience to understand, the risks of these different bridges. Across, then, we designed to be the most capital efficient bridge we could possibly do, while maintaining kind of maximum trustlessness and decentralization. And in our mind, capital efficiency here just means we can do more volume with less TVL in the bridge itself. And the thought here is that further reduces our like attack area or surface, attack surface. And maybe I'll loop this back though to Richard's point around just like what is the actual concrete use case for all this cross-chain stuff today? And it is asset bridging. That's why Layer 0 built Stargate. That's why we're focused on a cross, not as an arbitrary message bridge, but as an asset bridge. And I think it is really interesting to think through, and maybe there's a thesis here we could begin to kind of form of two different multi-chain futures. One where you're executing primarily on one layer 2, one execution environment, and bridging there is primarily assets and occasional messages. And the other is this kind of like omni future where I'm actually building on this infrastructure that can kind of under the surface it abstracts away and uses different chains at different times. And I think that's a really interesting future or debate to have between those two futures.
Well, one thing I just wanted to say, like we didn't build Stargate because we think asset bridges are like what people need, right? We built Stargate as this like underlying utility because what's the purpose of bridging? You want to move some asset over there, not so you can just hold the asset over there, right? You don't want to hold USDC. Oh, I want to hold it on, Polygon for some reason, right? I want to do something with it, right? And so going over a bridge and just hold it, that's just a multi-step that you're adding, right? I have to go do something, I have to swap to a bridgeable asset, then I have to leave that page, bridge there, and then go to another, AMM or farm on another side. But being able to put that together and roll that all up in one single transaction is the purpose of messaging, right? That's what Layer 0 is doing, and Stargate is just further enabling that, where you can now become this DeFi Lego, where every single DeFi application that's cross-chain or wants to be cross-chain builds on top of Stargate and is able to compose it.
Can I, and hopefully can I get educated from the answer? One thing that we wrestle with a lot is, it's one thing, should we say kind of DeFi for DeFi, kind of moving existing DeFi assets around, and that's fine. You may want to be able to kind of borrow against them and hope, go leverage long ETH.
Your mic's gone.
Mic's gone? Okay. Back. Hello?
You're just louder now.
Good. Okay. So, and so that's fine. But what if we want to try and get some, get, heaven forbid, some real world assets in here? What does that mean for your environment? If you've got like maybe an invoice that's been tokenized, for example, or obviously you can have NFT art, but NFT anything else, and you want to take that asset and use it as collateral for loans. And what if you go a step further and you've got automated market makers for those NFTs and a protocol whereby the NFT might try and sell itself? Does that argue in favor of that level of interoperability? Argue in favor of a more multi-chain world, or what have you contemplated that kind of use case?
I mean, I think makers are already doing like some of this, right, where they have like real world asset that they're pulling in. I don't know if that's necessarily a requirement for like to pull in real world assets if you need to use multi-chain. It could be an interesting one where if you're pulling in constant real world assets, you could tokenize them in some type of NFT or something and be able to move that between chains, right? And go to marketplaces, like, because you're pulling it onto it. Say you're pulling onto a faster chain for some reason, like you want, because you're going to have a lot of volume where you're pulling in a lot of them, and they're transferring hands a lot. But there might be the use case of multi-chain there would be you want to be able to move those assets to another chain and be able to that has potential more liquidity, right? Access to liquidity is what this omni-chain multi-chain future enables, where you can. It may be today it's Ethereum, but Ethereum has an expensive cost, and it could be a layer 2 in the future. And being able to move there freely and have access to that makes your assets more valuable.
Maybe for me at least, related questions like, does privacy preservation have a role to play here? From your perspective, try to kind of mask, be able to understand some parameter from some transaction on one blockchain, and know that that parameter is factually correct on another? Is that also part of your requirements?
I mean, I think that's I don't know if requirement's the right word, but privacy preservation is something people want, right? You're going to be you just don't want everything public all the time. And I think that's, unless we completely change the world, the way we think about society, where we just like have our asset lists super public for everybody to see all the time, that's not going to be the type of thing that people are going to want. And I think that is like something that we'll evolve or iterate into. And I
don't know. The privacy for us, it's just messaging. So if someone wants to go from a privacy chain to a public chain, and they're, for us, we're just moving bytes payloads. So like how they encrypt it or how they do that is their business. But layer 0, the actual message and being able to see how it moves between chains, because layer 0 exists and validates completely on chain, will always be like that part is public.
Yeah, I think privacy is something that many users are concerned about. And I think I might be able to like say something about that here, because I do a bit of research into zero-knowledge proofs, validity proofs. So like I think that there might be a space where you see cross-chain messaging that is being validated with validity proofs in future. Although I think that's much further down the line. I think what I'm more interested in is the potential of like cross-chain applications that you guys were talking about. And something that like I've been meaning to ask, what do you think some of like the biggest challenges would be like that you face, if you're gonna build something that has different functions on different chains? So let's just say, for example, you have a game that maybe stores the NFT itself on Ethereum, but like the game interactions are done on Solana, like that. Like, what are some of the challenges that a messaging layer itself might face?
And it's just a different overall design pattern. So most developers in the space are used to atomicity, right? And so having to think about it a different way, it's just like there's a learning curve there, right? Just like when someone goes to GPU programming and learning how to write parallel code, there's some learning curve there, and it's just there's different design patterns that get used there that you would never use on like a normal CPU.
Right.
Yeah.
Yeah, and I think this is something we were talking about backstage that I think is really important for people to zoom out and look at. We use the word, let's see if I can do it, atomicity. But atomic transactions are what enable, like if we go for a very DeFi-specific concrete example, if you're going to liquidate somebody on DeFi, in current DeFi protocols, you can do it with zero capital, because you can take a flash loan and repay the flash loan at the end of the transaction, and it's all executed atomically, or it's not executed at all. And flash loans, like I come from a traditional finance background, flash loans are a crazy concept. Like I can borrow basically infinite capital to do whatever I want to do, and I don't have to post anything. It's like wild, right? So if we start moving cross-chain and you break that, you can't do atomic transactions in the same way. We were debating backstage whether there is a way to do it, and there may be, right? But regardless, you are breaking some of the programming patterns that people already have. And so I think the challenge here, and again, this goes into like the thesis for what this multi-chain future looks like, it's possible developers don't want to break their current design patterns, and then they are building primarily in one execution environment, and the cross-chain stuff is around bridging assets or occasionally bridging messages. It's also possible that there's use cases where they really do want to program in a different way, and I think gaming is a good example of something like that like isn't really done. High performance gaming isn't done on current blockchain designs. Maybe it would be in that form of a multi-chain future. So I think it's really fascinating to think through that too.
Yeah, those are really interesting takes. Thanks for sharing. Yeah, so I have a question for Richard. More on the venture side, right? Like, how do you navigate the uncertainties when it comes to like deciding which of these layer 1s or layer 2s are like investable? What are like some of like your biggest doubts when it comes to evaluating which chain might stay on, which chain will not. Like, what are your thoughts on that?
So yeah, good question. So, oops, sorry. I mean, obviously, it's been sort of investing in layer ones, maybe several layer ones, investing in layer twos, maybe several layer twos, has turned out to be a reasonably good bet, especially if you came in at the right time and remembered to get off the train at the right time as well. So in that case, you could say a lot of people look smart, but weren't necessarily. I think, and so for that game, when we're trying to think about infrastructural components and work out which one we want to work with, I mean, I think it's all of the normal kind of criteria that you have as a kind of venture investor. You're primarily spending time with people and understanding whether or not these are the at that point technologists who are going to build the better mousetrap, and then you're perhaps getting into the next level of understanding whether there's this kind of heterogeneous sharded approach, or is it a homogeneous sharded approach, and what are the trade-offs involved in that, which obviously was one at one point in time, and maybe you're hedging your bets. I could say this, though, from our perspective, that we tend to back founding teams and try and be as loyal as possible to them. So it actually has presented a little bit of a interesting conversation, at least for us, because we kind of tend to go deep with a certain team and then want to see if we can support that ecosystem. But in a multi-chain world, that seems like that's a little hard because there's components everywhere. So we had to kind of adapt our stance a little bit. Then if you switch to the kind of the app side, we've certainly seen the kind of Starkware ecosystem on Ethereum do extremely well, and that has been primarily in our portfolio. That's primarily been driven by choices from the application teams themselves. So we're led by them as to which ones they want to work on. We wouldn't be coming in with a viewpoint per se, but rather, and maybe to link it back to this point about kind of development patterns and engineering trade-offs and and so forth. And even, specifically engineering trade-offs about complexity and security risk. I think the biggest opportunity for the industry, the ecosystem as a whole, remains getting developers just to come in and develop anything in the Web3 environment, and to just start. I think anyone who's had a security breach is trying to keep things as simple as possible, although arguably, if you're not doing well, it doesn't matter. You've had a security breach, and if you're doing well, then often you can navigate out of that particular hole. But I think I was curious actually, and I don't mean to kind of entirely bounce the question back. When you're thinking about your go-to-market, and we wrestled with this a little bit backstage as well. You strike me in both cases to be quite broad and horizontal. Or maybe you're just currently serving the DeFi use cases we've been covering. Oh, should we be doing more in the ecosystem to try and identify say the gaming use cases and work more tightly with them, and then think more thoroughly about the go-to-market? That always used to be a really important part of early stage venture, thinking that through. And actually, it doesn't come up as much as I think in the more mature Web 2 markets that I've invested in historically. So
when we started Layer Zero, we thought it was mostly going to be DeFi that was building on us, but actually 50% of our inbound since we've launched has been gaming, NFTs, and any NFT marketplaces and stuff. And a lot of them, right, are building games that need their own specific chain, right? Because they're mostly afraid of even fast chains, right? That some NFT drop's going to bring the chain to its knees during that time and affect everyone negatively.
How many of them are already using multiple chains?
Say again?
How many of them are using? They've got their own chain, but how many of them?
So what they're doing and why they want Layer Zero is great. When you make a gaming chain, you have NFTs, right? Or you're gonna have items in the game, and now those users who are going to play that game want to be able to sell it. So they got to build a marketplace. And now you need to get capital on there, in and out, right? And those aren't your core competency, right? You're doing things that you don't want to be doing. You're reinventing something that someone else already does a lot better than you're ever going to do. And so Layer Zero enables it so that I could move my assets off that chain and have them natively exist everywhere else. So I can bring it to, say, Ethereum and list them on OpenSea, and then have access to all that capital liquidity. And the users who are buying them are then going to buy those NFTs and bring them back to the game. So now I have more users I'm able to touch. And I can go to all of those chains, not just Ethereum. I can go, Solana, and I can go to Magic Eden or something, or OpenSea there, and then have access to those users and bring people into the game. And then I give my users the ability, so they give their users the ability on the gaming chain to then, go wherever they want and have the asset is more valuable to them because it's not just like this closed ecosystem. I could bring my NFT or whatever asset I have off that chain.
To be clear, Ryan, you guys aren't bridging NFTs yourself, right? This is like, you're just, again, doing the messaging of this and letting the application do the NFT bridging.
So we came up with this standard we call Omnichain Fungible Tokens, which is, we abbreviate OFTs, we call them, and then Omnichain NFTs, right? Or ONFTs. And it's basically, what happens is these creators deploy the same contract on every chain, and it's like a 721 for NFTs or 1155, and then whatever that version is on Solana, right? The Solana has a built-in NFT, and they communicate with each other. So and it's up to how they want to do it, whether they lock and mint or they burn or destroy it, I guess, and put it on the other side, right? You're moving between chains, and it's the key there is that since they're deploying it and it's their smart contracts, it's not a wrapped asset. It's maintains that provenance because when they deploy their NFT in the first place, they deploy it on all chains and they're connected via layer 0 messaging.
Yeah, I bring it up because I think it just also shows how early we are. I don't think there's yet the design pattern of how you're supposed to move an NFT between chains all figured out. Right?
Oh yeah. Because the demand was so high for these gaming chains, like, well, how do we move these NFTs? We realized we needed to make something.
Yeah.
So we created that, what we call the NFT standard, and basically they need that. It was out of necessity, and they are using it now. And a lot of new gaming chains, Avalanche subnets, Polygon supernets, are coming out with this built in.
Yeah, it's still just such an interesting concept too, because if the idea of there not being one settlement place for this thing, like a native asset, does make conceptually the most sense for it to live in one spot. And then if it's something that's non-fungible, like an NFT, moving that around can kind of make your head hurt. But these are all the use cases that I think are still getting sorted out and figured out right now.
Sure. And I think the most important part about it's not how they move, but how it's viewed, right? And so making sure that these exchanges can or marketplaces can properly see, like OpenSea, they could see if there's a agreed upon way that we all read between all of the chains where an NFT, an omnichain NFT is deployed, right? If they can see, okay, there's this many, and these are the ones on Ethereum, and this is on Arbitrum, and this one's on Optimism, and they show it as one collection, right? That's the problem that you're kind of getting at there, Hart, is if there's no unified standard like there is with ERC20s and 721s, 1155s,
yep.
Then the market, it's hard for these marketplaces to kind of view all the different versions that are out there, which is why we went ahead and made this standard.
Yeah, I can definitely see the utility that a messaging protocol like that can provide. I guess one last question that I might have here is with regards to with such a messaging layer, right? What exactly is the value accrual mechanism when it comes to interacting, across chains? Because on Ethereum, you pay gas for transaction, but when you're using layer 0 messaging protocol, how exactly does value accrue on layer 0?
So layer 0 messaging, I guess, is the way it works is there's an oracle and a relayer, and oracle and relayers are kind of misnomers because they could be anything. It's an open and permissionless system, and an oracle's job is to move a block header from one chain to the other, and then a relayer's job is to move a transaction proof and validate on the other side. Now those the oracle and relay are abstracting gas on the destination chain, and so gas is volatile, especially can be volatile, especially on Ethereum, and so they have to buffer in some type of I guess amount for volatility. And so usually it's a couple percent, maybe up to 5% to buffer that. And so that is where the profit for oracles and relayers lie, is that volatility and buffering properly and having enough to, because they have to deliver it no matter what. And so if they don't properly price it or they underprice, they're eating that cost on the destination chain and not making and losing money. So it's a balancing act. And then since it's open and permissionless, and we will have I guess metrics for them to choose from when you're picking an oracle or relayer. How much are they? How fast are they? Are they waiting because they undercharged and now they're waiting for price of gas to go down, so they're adding latency, right? Things like that, and allows this marketplace to then get pricing in the right place for applications to choose from, and that's where so Layer Zero Labs runs a relayer, and then that's where Layer Zero could make money.
Right. So
yeah. Well, I was just gonna say, so for an asset bridge, it's pretty obvious how the protocol could make money. They take a sliver of the asset getting bridged, and that makes conceptual sense. It's actually interesting to hear Ryan describe this. So if I'm going to summarize it, you basically have the protocol slightly overcharge gas fees at some level, but you're saying it's an open architecture, so where does that go? It doesn't necessarily go to the protocol, but maybe Layer Zero Labs runs a relayer that does a good job and people tend to pay for it. It's an interesting question though of I don't think there is a model that's established for how to extract fees from a messaging protocol here.
Because you don't know with messaging what's going across it, right? It could be, you don't know the value. It's a bytes payload, so how do you properly price it? You can't so it matters. It basically comes down to pricing on gas. We're paying on the other side. We're performing some service, and there's some risk that's being taken. It's a market maker in gas, and so figuring out what that is, and buffering and some amount of profit there.
Right. So I guess that's it for our time here.
Refreshing to hear questions about business models in this environment, but yeah, interesting.
Bear market questions.
Yeah. So that's it for us. Yeah.
Thank you.
Thank you guys so much.
Thank you, everyone.